All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. I'm flying solo again this week, and I'm cool with it. I like doing these solo shows. It allows me to kind of add my own little flair of things and talk about my opinions more directly and get a little bit more personal on things. What I wanted to talk about this week is why we buy LIHTC properties that are in the extended use period. Matter of fact, that's our strategy. Some people think that it could be a limitation. However, I think that there's a ton of opportunity in LIHTC, and I know that a lot of people have been following Tim and I for many years now, as we've been basically solely focused on extended use LIHTC properties in the Carolinas, specifically over the last 3 or 4 years. We're of our entire portfolio, I think maybe about 1,000 of those units are LIHTC in the extended use period. We've got a couple of properties that have come out of the LIHTC period and are now market rate properties. And by no means do we also do look at market rate properties. Let me be clear, but our target is after LIHTC properties. And if you've seen Tim and I talk at any kind of mastermind or conference or anything like that, hey John, good morning. You'll know why we do LIHTC specifically. Um, in the LIHTC world, development is where a very incredible lucrative amount of money is made in LIHTC development. But when you're developing properties, you're exposed to the same level of risk that any other developer is exposed to. You can have material changes, labor delays, contractor issues, um, weather delay. Whatever have you, right? I mean, there's so many different things that could come up during your development project that could ruin your development. That makes things incredibly more stressful, right? You still have to deal with entitlements. You have to do with the application to get the LIHTC credits, and for one thing or another, when you're buying a LIHTC, or sorry, when you're developing a LIHTC property, one of the values of doing a LIHTC development is the credit, like the tax credits. And a lot of people are familiar with the tax credits. I mean, LIHTC stands for Low Income Housing Tax Credit. I mean, it's literally in the name. But the only way to get those tax credits is if you're the original developer. So I do want to talk a little bit about just the tax credit piece alone, and expand on that a hair, just to kind of bring more awareness to it and a little bit more understanding. And let me be clear, I had to do a little bit of research on this myself, just so that I make sure that I talk about it correctly. Tim and I have never done a development deal. We've never had to deal with the tax credit side of things. So I did do a little bit of research just to make sure that I'm reading it correctly. But essentially, when you're doing your tax credit development, you have to apply for 4% or 9% tax credits. If you get the 4% tax credit, which to my understanding is in relation to the 9% tax credit, it's very easy to get. But the 9% tax credits mean you get more tax credits for the development. And generally, what that means is that there's a bigger need for affordable housing in the area that you're developing in. And that's a way for the IRS and local municipal housing authorities and state level housing authorities to incentivize building in certain areas of town. Every December, or every other December, there is a study that's put out that identifies what parcels and what areas of town will qualify for 4% and 9% tax credits. And if you are a developer, you are paying attention to that every December, and you are trying to actively go out and acquire property that you can build your LIHTC multifamily assets on, right? But one of the risks of doing development and dealing with the tax credits is that when you sell those tax credits to a corporation or high net worth individual, or whoever you end up selling it to, surprisingly enough, that's actually called syndicating your tax credits. Different than what most people who are probably listening to this show understand of what a syndicator is. With multifamily syndication, meaning we raise funds from private investors, and we put together like a 506B or a 506C PPM syndication. But one of the risks of development, and I actually didn't know this until very recently, is that when the LIHTC credits are sold, the buyer of those tax credits give you the money up front in order to acquire them. And one of the jobs of a LIHTC developer is to deliver the credit risks on time. And essentially, what that means is if you've ever looked at an 8609, if you've underwritten some affordable LIHTC properties, if you've looked at an 8609, there's the date that of which the tax credits are awarded, and then there's the date that the property was put into service, and that's called the delivery date, right? And the delivery date by the IRS standards is that the property has been constructed, you have your CO, and it is occupied by tax compliant, um, LIHTC tax compliant residents. I don't know what the occupation threshold is to be considered placed in service. However, if you complete your build on December 31st and you don't lease up the property to whatever that occupancy percentage is until May 1st, then it takes you 4 months to lease up the property, then you don't actually get awarded those tax credits on until it's placed in service. And one of the things that you have to do as the developer is the tax credits cannot be utilized by the person you sold them to until the property is put in service. So there is a delivery time frame of which developers are fighting against in order to develop the property, to navigate risk with material and labor increases or declines. Or I mean, think about COVID when the price of timber like doubled and tripled. I mean, as a developer, nobody's shielded from that. But the third delivery risk there is in making sure that you finish the project on time with which was agreed upon with your LP who purchased your tax credits, that it is put into service by a certain time, because they are expecting those tax credits to be delivered so that they can use them, right? So they give you the money up front, and then you have to build it and you have to fill it before the tax credits can be utilized by the LP, right? So there's a lot of risk and there's a lot of stress on the developer in order to meet those deliverables and those timeframes. If those delivery dates and placed into service dates are not achieved on whatever is negotiated and agreed upon, you could find yourself in having your tax credit amount reduced. So maybe you qualify for 9% tax credit development, and now you only qualify for a 4% tax credit development. That will effectively reduce your tax credits and create a tax liability for the developer, because then they're going to end up having to owe money to the LP that they're not getting all of the tax credits that they purchased and pre-funded. You could have penalties assessed at the IRS level or with the housing authority. They could assess penalties for not delivering it and putting it into service by an agreed upon date. There's a lot more risk in the development side of things um, than most people are aware, myself included, because I've never done it. Right now, Tim and I, we only buy LIHTC properties that are in the extended use period, so we don't have to deal with any of that. We don't deal with the development. We don't deal with the tax credits recaptures. We don't deal with having to deliver anything to the LP. We essentially buy multifamily product when it's in the extended use period, and the deal just operates like a multifamily property at that point for us. Now, one of the risks that we have is that we have to make sure that our compliance is still done correctly, right? So, like, we're purchasing a property that has a LURA, which is a land use restrictive agreement. We have to honor that agreement until the LURA expires or comes out of LIHTC. And generally, that's the first 15-year period is called the initial compliance period, and the second 15-year period is called the extended use period. That's generally the standard, 30 years total. The first 15 years is when the tax credits can be recaptured and clawed back if you fall out of compliance. So it kind of made a lot of sense to me now why, when we're buying extended use properties, there's a lot of value add for Tim and I, right, and our investors, because when the developer is developing the property, their main goal is to put the property in service and keep it full and operating and in compliance. And it is much harder to find a resident that meets the qualifications and the guidelines in order to live in your tax credit property than it is to retain one, right? So you have much higher leniency on a renewal and less paperwork that needs to be done on a renewal of a LIHTC property than when you're assessing a new resident to come in. So on the developer side of things, it's a lot easier for them to just keep the property full. And when Tim and I go and buy a property, it is not uncommon to find that the rents are $500, $600 and the net max rent that we can charge to is like 1,000 or 1,200, because the goal of those owners is not to make it so that the rent is continuing to go up. Their goal is to keep it full. They don't want to spend any money on deferred maintenance. They don't want to have to deal with tenant turnover. They don't want to have to deal with any of the complexities of increasing the rent roll. Now, Tim and I, that's where we make money for our investors, is we increase the rent roll, we take on the risk, we handle the deferred maintenance. Generally, these developers are building property and they want to just sit on it for 15 years. So when we're underwriting these deals and we're buying them, I mean, we're buying a hard asset that's existing and it's producing cash flow, and we are able to purchase the asset at a significant reduction to replacement cost because the rent is limited. So most everybody listening to this show know that multifamily properties are based on its NOI. All commercial assets are based on their NOI. And if your rents are restricted, then your NOI is not going to be higher, like comparatively speaking to like a market rate property. So a market rate property will be worth significantly more than a LIHTC property would be, even if the LIHTC property is newer than the market rate property, right? And we have many examples of properties that are built in, a lot of our assets now are built in like 2006, 7, and 8. And those properties are significantly newer and in much better condition than some of the properties that we had bought as value add deals that were built in the 60s and the 70s. And it ultimately comes down to the NOI. So another thing that is important to realize is that commercial real estate investing is very, very favorable over a long period of time, right? If you're trying to flip properties in and out in like 12 months, 24 months, generally the risk is higher. I'm not saying that you can't do it. I mean, we know people that do it very, very successfully, but that just doesn't really work for us that well. But generally, if we're buying a property and it comes out of the LIHTC period, when it comes out of the LIHTC period, the property will be worth significantly more because it opens up your buying pool, your buyer basis, right? Of saying, well, my in-place rents today are 600-700, but market rate rent is 1,500, right? Now there's also, like I just talked about, there's a gap in between where you're buying it from the original developer who's gotten their tax credit allocations and they delivered it, they made their development fees and everything that they need to make money on the deal. Now it's our turn. We come in, we increase the rent from where it is to where it can be, and then we can either sell it because we improved the NOI and let the next owner ride out the LURA until it expires, or we can ride out the LURA to expires. But generally, it's assumed and can be proven that most LIHTC properties, the net max rent that we can charge our residents is significantly less than market rate. So by definition, if you're able to hold a property long enough and the property comes out of the LIHTC period, when it comes out, you can increase your rent roll to market rate free and clear because you have no more restrictions that you need to abide by on the title. So there's a lot of complexity with buying LIHTC. Let me tell you, I am learning more and more about LIHTC every single year that we are involved in this space. We recently met somebody that kind of opened my eyes a little bit more to how lucrative the development side of things can be. And it really has made it a goal for myself that within the next 5 years, I would really like to be in some development. Now, I'm not saying that we won't buy extended use properties or existing market rate properties, but I do want to be able to add that to our balance sheet and say, well, we have some long-term money that we do some development. Tim and I just own it ourselves. We do it 50-50. We do the development. We sit on it for 15 years. We use our management company to operate it for those 15 years. We stay in compliance. We build in markets that we like, that we know, that we trust. And, in 15 years, we'll look at selling it and moving on, or, much like a lot of other people in the LIHTC development space look at. There's definitely levels to this, right? So like, we started out buying extended use properties and using third-party management. Then we graduated to having our own management company. And now, as we continue to learn how to operate the LIHTC properties more efficiently, just kind of build relationships with everybody at NC and SC housing, right? North Carolina, South Carolina housing. We've very quickly become on a first name basis for operating the properties well and handling deferred maintenance and taking care of problems that the previous owners have left us. So we have a good reputation for that. Has it been the most elegant fall into grace? No, I guess it's been more of a fall into grace. We've learned, we've screwed up, we've failed, we've tried a million things, and every time we're learning something new on how to do something or how not to do something. So it's continuing to get better and better, with the ultimate goal of when we start doing light tech development, we'll be able to manage our assets very, very, very effectively and stay in compliance because we've been through that game, right? Like we've bought properties that were out of compliance into compliance, and we've maintained compliance. Now we're ready to do the development and manage it for the 15-year initial compliance period. So there's all like steps there, right? And it's not something you just jump right into, in my opinion. Now, I'm not saying that somebody else had not done that. I mean, I'm sure there's examples of people that had never done anything except for light tech development, but our path and our journey looks like what I just laid out, where we were syndicating market rate properties. Then we got introduced to LIHTC. Then when we bought our first LIHTC, we used third-party management. Now we have our own management company. Now we're just continuing to grow in the space, right? I mean, it happens over a long period of time, and when we're grateful for the journey, and it's been a lot of learning lessons, I'll tell you that, right? But that's specifically why our strategy has been to buy extended use property right now, right? We're buying the property based on its in-place NOI at a significant discount. And there is a path, and we can very clearly see the path of increasing the NOI or just riding out the LURA until the properties come out of compliance. And then once it comes out of compliance, we can renovate a couple of the units from classic to renovated, and then bring them up to market rate rents, and then we can sell it on a pro forma basis, right? And say, hey, like, you're going in cap rate's going to be pretty low, but look at what your stabilized cap rate will look like once you increase the rents to market rate, right? Or we have the option of doing that ourselves, right? I mean, it all just kind of depends. Each property is a little different. We are aware of some properties in our portfolio that we're like, hey, when this thing comes out of LIHTC in the next couple of years, we're going to convert it to market rate entirely, and then we're going to refinance it again because I don't want to sell this place. So now, you think about it, you bought a property 5, 6, 7 years ago, it came out of compliance, the market has continued to go up, market rates continue to go up over a long period of time. And now you're sitting on an asset with a very, very, very low cost basis, hopefully very good cash flow at that point, because your debt service might be pretty low from where your NOI used to be compared to where it is today, and that's how you make money, right? And I think with how 2020 through 18 through 2023 or so, a lot of people just got so comfortable with buying and selling and buying and selling, myself included. We had done a lot of that, but now that the market has turned, it's definitely not as hot of a market as it once was. Multifamily property values are down 20-30%, or if not more, depending on what you purchased it at. We talk about this all the time. This is a dead horse, but with tax increases and property insurance increases and utility usage rates going up across the board, payroll never seems to go down, right? All of those things are kind of working against you, but at the same time, you bought it at such a good basis that hopefully you're able to sell it, for whatever your market rate properties are trading for at that time. So for us, like buying the LIHTC extended use, it's a risk adjusted return for us. I like to be able to underwrite deals with in-place cash flow. I like to know exactly what I can charge for rent. Oh, and that brings up another great conversation is when we're underwriting these deals and we're buying them, the government tells us what we can charge for rent, right? Every year, generally it's on April 1st. Hopefully, I wish it was tomorrow, but generally it's on April 1st. But this year it's going to be May 1st because of the government shutdown. So HUD is behind on doing their average median income and average median rent assessments to tell us what our gross rent limits are, as well as what our new utility allowances are going to be at each property. But essentially, the government sets what the rent rate is. And when you're buying a LIHTC property where the rents are 600, you can pull up the factual data of the exact amount that you can charge somebody for rent. So when you're underwriting a deal, you know exactly where your rent roll is going to be. There's no speculation of what your rent roll could be during your value add process, right? So like, it might take you a year, 18 months, or 2 years to accomplish your pro forma, but your pro forma is built out on what the rents that you can achieve are today. And I can show you like a government document that tells you exactly what you can charge for rent. So there's very little speculation in the rent roll when you're buying a value add LIHTC deal. Now, one thing that we do when we're assessing a new asset is we build out a trend. So I take a look at all of what the rents have been over the last 5 years, and if historically the average increase has been going up or going down, you kind of look at it as what's the average been over the last 5 years, and then how has it changed each year in between there. So like maybe you had one year there was a 20% pop, and then you had a 0% pop, and then you had a 5% pop, and then a 2% pop. I'm not going to underwrite to a 20% increase every year over year. I might increase and project that my rents over the next 5 to 7 years increase 1, 2, or 3% per year. Pretty standard with what you would do in a market rate property. But the real difference here that I want you to take away from is analyzing on an acquisition what your rents are today based on the in-place rent roll and what they can be. That right there is going to tell you what the property is worth today versus what it'll be worth when the rent roll, like when you've completed your value add. Hopefully, rents continue to go up. There have been cases where the rent has gone up, but the utility allowance went up more than the rent increase, so our net rent went down. And there's nothing I can do to control that. It also helps on the management side of things too, if you're curious, as the management side of things. When tenants push back on rent increases, we tell them, hey, like this is literally what the government says that we can charge you, and this is it, right? It's not some pie in the sky. Let me just see if I can get an extra $100 out of this person on a rent increase type of scenario. It is dictated to us what we can charge for rent. And some pushback that we get on residents is saying that the rent increase was too much. But we remind them that they live in a 50% or a 60% set aside unit. And if they want to live in this specific area, all of the properties in the area all charge the same rent. And you're welcome to go talk to another LIHTC property and see what they're charging for rent. Maybe they're charging less because they don't really want to push the rent roll. But generally, you can assume that everyone that's operating a LIHTC deal in the space is charging the same amount of rent because that's what they tell you can actually charge. So it takes a big risk factor out of the equation when you're acquiring a deal because you know what you can charge today. Now, obviously, it doesn't remove the future assumption and the projection of what you think rents are going to do. But if you take historical data, that's the best you can possibly do. So again, we talked about risk profile. We talked about our basis advantage when you're buying a LIHTC asset because the NOI is significantly less than a market rate property. Your basis will generally be a lot less because you're able to buy it on in-place income instead of pro forma. Another thing that we find is a really great kind of perk with running LIHTC assets is the demand stability. We don't have to pay for any type of marketing because we're affordable LIHTC housing. So we're listed with the housing authorities. We put flyers and bulletins in the housing office so that, if somebody has a voucher, they're able to come, and look at our property and see if they want to bring their voucher with them. If they don't have a voucher, they can still apply to rent in our location. But with the affordability crisis that's going on in the country, a lot of people meet the income restriction levels that are required in order to live at our property. So we very rarely spend any money on marketing because people come to us because we're listed as a LIHTC, asset. And there's websites that you can go on to find the LIHTC assets in your area. And that is generally communicated with people so that you can help them find housing. One of the things, our vertical integration serves us well because we operate, we manage, and renovate everything in-house. Our management company, we don't charge markups on any of our, software costs or overhead costs. We charge actual payroll to our properties plus a management fee, and anything that is charged to the property is because it is specifically used by or serviced for the company. So for example, we might have, it's very common in our business where we have a property manager who manages 3 40-unit assets that are within a driving distance from each other. So we give them a car allowance to cover their mileage, and the car allowance is split between those 3 properties evenly based on the unit count. So we don't make any markup on that. We don't charge anything added there, and ultimately the whole goal of owning and operating your management company there is so that you can operate the properties more efficiently without markup. I'm not knocking on it, and I've said this before many, many times. Third party management companies have their place, you know, but you have to understand that a third party management company is a for profit business and they are going to be looking to make money off of you and your investors any way possible. And the widget that they make money off of is providing a service to your property. We charge a management fee. Yes, that is a standard business practice. We have accounting folks that have to get paid. We have, a director that has to get paid. We have a compliance officer that has to get paid. All of that is paid for by the management fee. Um, you could argue that you should just charge those fees directly by unit to each individual property, but not every property in our portfolio is LIHTC. Some are market rate. So, other properties that don't use our compliance officer shouldn't have to pay for it. So that's just how we're structured. And I know everybody does it a little bit differently. And the last thing, what I love about our business strategy, we don't think it's a limitation, and ultimately that's proven because there's less competition in the space. Uh, I can't tell you how many times brokers bring us deals because they just know that we buy LIHTC assets, and that doesn't limit us to only buying LIHTC assets. In fact, we get a lot of market rate properties too because we talk to them so frequently. They're like, "Hey, we built a great relationship, and I know you generally only buy LIHTC, but you got to take a look at this market rate property over here." So we buy, LIHTC, we buy market rate, we have some triple net. We do a little bit of everything, but our main bread and butter and our focus is LIHTC. So yeah, I know I put a lot of information out here today. I hope that you guys got something from it. Maybe you want to talk a little bit more about LIHTC and how it can be involved in your portfolio. I think maybe this year we'll start bringing on some management for other people's assets, as long as they're in the Carolinas and they're LIHTC. Generally, that is how we're going to have even more economies of scale. Not only help our own portfolio, but also help those people that are hiring us. So if that's something you're interested in, you can reach out to me as well. But yeah, appreciate everybody joining the call. Genevieve, Dennis, good to see you guys. Thanks for joining. Appreciate you guys joining here all the time. And if you have any questions, shoot me a DM or a message on Facebook, and I'd be happy to chat with you some more about it. So until we talk next time, peace.